Start with you, David. Given kind of that backdrop that Bob just pointed out, things are starting to look up. Growth is starting to work again. I mean, is this a temporary phenomenon, or is this just back to 2020, 2021 again?
Yeah, it is way too early for us to look and say that this is going back to prior to the pandemic. I think we have a lot of noise ahead of us. The consumer is definitely spending less. Rates are going to stay high for a little while, and that's why we like our clients to actually move into bonds. We think bonds are back right now. And what we're seeing is a meaningful bounce off the bottom. Once we know that interest rates have peaked, then I think it's going to be possible for us to really dive back into growth in a serious way. But I think it is far too early not to take seriously the fact that for the next 6 months, we're going to see a slowing consumer, and we're going to see growth rates across the world, from China to Europe to the U.S., actually slow down before we actually know whether or not we're going to have a full-blown recession, even a mild one. And I think that focusing on earnings just right now and saying this is what earnings are going to be actually ignores the fact that there is going to be revenue pressure and margin pressure over the course of the next 6 months.
Ernesto, what do you think? You think the market is accurately reflecting what's actually happening on the ground and what's expected to happen on the ground? I mean, to David's point, we're looking at least what's largely been telegraphed as a 75 basis point increase next week. I mean, that seems like it wouldn't bode well for companies that aren't necessarily super profitable, super cash flow generative.
Yeah, you're absolutely right. The market is not focused on what's going to happen tomorrow or even in the next 3 months. The market already knows that, and it's looking through that. So today's earnings are not what the market is looking at. The market is actually looking through the downturn. And in our own research, we're estimating there's a decent probability that we are at an inflection point here because of the fact that the market is able to look through. And the biggest risk here is that we have a very strong recession, a pronounced recession, as opposed to a mild recession. But if it is a mild recession, the market is certainly looking through that and anticipating a recovery. So we are positioning our portfolios away from defensive and value, which worked very well for us for the last couple of years, and nibbling at higher growth, but making sure that it's growth at a reasonable price. We're not paying through the nose, because we think the market is ready to move in a new direction, and that's what's driving our positioning today.
So do you think that, just to follow up on that, Ernesto, do you think that a soft landing is off the table then if our options are mild recession or severe recession?
Yeah, well, I mean, when you're at levels of growth like we were last year, we're going to have a meaningful deceleration of growth. Whether we enter into a recession or not is for a bunch of people at the National Bureau of Economic Research to decide. We're actually in a technical recession. I think when you see the GDP number next week, we will have satisfied the 2 quarters in a row of negative growth requirement for a technical recession. But it's irrelevant whether it's a technical recession, an actual recession. The question is how much of a contraction we're going to get, and if it's a mild contraction or a soft landing. I think the difference there is relatively benign, as opposed to a deep recession like we had in 2020 or even 2008. I don't see that we're going to get to that level of a recession, but it could happen. The Fed might commit a policy error, and that's one of the concerns that we have. Although, because they're so focused on the data, we think that they may be able to navigate to call it a softish / mild recession type scenario.